You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out. Basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo and Dan Passarelli.
All right, everybody. Welcome back to Options Bootcamp. I like that. Nice rockin' tune to kick off the show here. We don't hear it as often as we'd like here on the old network, but welcome indeed to Options Bootcamp, the program here on the old Options Insider Radio Network, where we take you, the beat, the broken down retail stock trader, and then we break it down some more, as is the Bootcamp drill instructor fashion, and then we build you back up into seasoned options veterans. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. 15 programs for you guys to sink your ears into on the old network. The easiest place to get all of them, including a lot of the back episodes. We go back almost a decade now here on the network. So sometimes platforms like iTunes and others, they'll clip you at 50 episodes or whatever. So if you want to get all the goodness, then theoptionsinsider.com, the easiest place to do just that. Click on the Insider Radio Network tab, and your journey has begun. Of course, while you're there, it's also breaking news from the options market. A lot of that curated in a fun little show called Options News Rundown, from a guy you may have heard of, called Mr. Dan Passarelli. We'll get to him in a minute. And also, you can always find the radio if that's what you really want. You just want to mainline the radio. iTunes, TuneIn, Stitcher. Just added Google Play podcasts as well as iHeartRadio. They just kind of came online for podcasts recently. So as new outlets come online, we will continue to add them so you can find us pretty much anywhere you find your favorite podcast programs, including in the app stores where we are available as an app to search for Options Insider or Options Insider Radio Network if you want to go for the full way. You'll get our network app. All the programs are there as well. That's also a good way if you want to dive into some of the back catalog, particularly. You can get it all via the app. We don't cut everything off there, obviously. You can get that in the Google Play App Store, the iOS App Store, even the Amazon Fire App Store. So if you're rocking a Fire device, and all three of you out there know who you are, then we have an app version for you. And of course, however you get the show, including today, for the first time on Bootcamp, streaming it live via Mixlr, M-I-X-L-R. You can get that link if you follow us along at Options or anywhere else we post these show programs. We'll post that link. If you follow along with any of our other programs, like the Option Block or Volatility Views or TWIFO, it's the same link, same Mixlr link. It never changes, so you can just kind of bookmark that. And if you want to, I know a lot of you have also done, you can follow us in the Mixlr service itself, and that way you'll be notified the instant we go live with a new program. So you guys, this is going to be a fun one today too, because we're going to have a chance to get some of your live questions. We're going to do that a variety of ways, also via Mixlr, as well as via the community of this man who is joining me right now, my cohort on the Options Bootcamp program, the yin to my yang, my nemesis in all things options, Mr. Dan Passarelli, the black hat instructor over there at Market Taker Mentoring. Mr. P, welcome back to the Options Bootcamp program.
Well, hello, Mark. How are you?
Are you feeling good in nemesis-y today?
I am. Yeah, I'm ready to be your nemesis here.
When I think of my options nemesis, it is clearly you, sir.
So Mark pointed out that you can ask us questions live via the MTM Elite Trader community. All you have to do is go to markettaker.com/community. Right, we kind of shortened it, made it a little easier for you. So that's market, like stock market, Taker, like take something, so 2 T's in a row, markettaker.com/community, and log in, and we will be able to read your questions real time and answer them. And it's just like, terrestrial radio, right? Is that kind of what it's like, Mark? I don't know.
Yeah, like the old school terrestrial radio, just done with a very new school tech twist. Which we like. No one wants a broadcast tower anymore. No one wants to be within 15 miles of a tower here in downtown Chicago. We want all you guys in Dallas and even in Reykjavik at 2 a.m. All you guys can tune in and have the fun.
Reykjavik, is that one of those cities that the libertarians don't know about?
Yes, because it's far from our shores, but still, we welcome all of our Icelandic listeners as we roll right on into our Options 101.
It's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Print bear to learn. Yes, sir.
All right, easy for me to say. This is actually our basic training segment, of course, Options 101. Different program entirely. So yes, this is, of course, our basic training segment, the portion of the program where we break down some basic options concepts, some principles, some ideas that you guys, as a proverbial basic retail stock trader looking to dip your toe into options, maybe you played around with options a little bit, you want to get a little bit more sophisticated. These are some concepts you should be familiar with. And Dan, we took our cues this time from the Market Taker Mentoring newsletter, actually. If you're not a subscriber to that, it goes out every week. Dan will fill you in with a minute on how you can get access to all that goodness. But Dan, you guys were talking on a recent newsletter about the mysteries, the nuances, the vagaries of kind of a less heralded part, shall we say, of the options market. Not the sexiest thing, not the part that really people are clamoring when they come into your class to ask about, because they probably don't know about it. But it is extremely important, particularly for some of these products that get a little bit funky around this time. Of course, I'm talking about the whole expiration and settlement process and assignment process. And if you're not really familiar with it, it's a weird thing. If you're coming from stock, this is not something you really ever have to deal with. Your stock doesn't expire. So it's kind of thing, how many times have you heard this? You buy a stock, it moves against you. Oh, that's a long-term hold now. You just leave it in your account, and a couple years later, when it gets back to break even, you sell it out, and you never have any sort of assignment to deal with or expiration. But options, obviously a little bit of a different beast. They have expiration dates. And so a lot of funky things happen when you get around that period where the option is about to expire. How does that process work? How does it work for different products? What does it mean for you to be going into this expiration and indeed this settlement process? What does it mean if you're short options? What does it mean if you're long options? These are a lot of things that could be kind of overwhelming and a bit intimidating and a bit kind of opaque to newcomers to the options market. So Dan, I don't want to steal your thunder because you guys were all over this topic first. So I'm going to let you run with this. But well, first off, tell our listeners if they want to get access to your newsletter, where they should go, what they should do, and then dive in, sir, because I know this is top of mind for you, on the mysteries and nuances of this little thing we call settlement here.
Yeah, so it's a little different with options than it is with stock. There's a lot of things that are different. First of all, like I was just talking with Craig Garby, our new instructor, yesterday. We're actually talking about futures, but it's the same for options because they're contracts either way. He was saying, it's kind of interesting with stocks. There's a float. You just can't, if you're a big, gigantic professional trader, you can't just trade, as much stock as you want. You basically can. You have limited capital, but there is a limited number of shares. And with options and futures, for that matter, there's really, there might be position size limits, but, they're contracts. The contracts are created when you first put one on. Now, the other thing, of course, is, and what we're going to be talking about today, is that at some point, all contracts expire, which is very, very different than in the stock world. With stocks, you buy a stock and, Enron expired, but stocks typically don't expire. They last in perpetuity until the company goes out of business or is taken over or changes from A shares to B shares or something like that. So, yeah, I mean, just kind of kicking off in very basic high level, just kind of introducing that concept.
Yeah, it is an interesting concept. It's one that doesn't get a lot of the sexy play. You don't see a lot of people on webinars saying, "Hey, come in and sign up to learn about the mysteries of settlement." But if you don't understand it, it's the kind of thing that could easily turn a decent trade into a dangerous or perhaps a less profitable or perhaps even an unprofitable trade, depending on how you go through it. So let's walk through it in some basic concerns. And I like the way you guys approached it on your newsletter. You broke it down into two essentially different categories. The first being options on individual equities, so your Apples, your Facebook, your Googles, et cetera. And then the second, and also a lot of ETFs. And then the second being broad-based indexes. Now that gets a little bit screwy when you get into things like SPY, which is obviously an ETF, but also an index. So we'll kind of get into that a little bit. But let's start off with your basic individual equities. Now, listeners, it used to be a lot more wiggle room in this process. It used to be if you bought an option, of course, options they give you the right but not the obligation to exercise a stock and buy or sell a stock at a particular price by a particular expiration date. Now, when you get to that expiration point and you have this threshold, well, let's say your option used to be if it was more than a nickel in the money, your option would be automatically exercised for you. You didn't have to do anything. Now, of course, that left a lot of wiggle room there. What if it was 3 cents in the money, 2 cents? And a lot of people kind of fell through the cracks. They may have forgotten you had to proactively contact your broker. And it was a very laborious process, and a lot of times these options just fell through the cracks. It wasn't that big of a deal because it was usually just a few cents. Sometimes something could happen in the interim over the weekend. The stock could move aggressively, and you could miss out on a huge profit or maybe lose a substantial amount of money on a position you didn't even know you had because you forgot about the exercising process. Now that automatic exercise threshold has changed. So now if you are long an option going into expiration and settlement, then it's only has to be in the money by 1 penny. So effectively, you can't be really half a cent in the money. So you can, but it's not going to happen very often. So typically, you have this scenario where once you have any tick in the money, your long options are going to be exercised for you. Now, what does that mean? Well, of course, if you're long a call, that gives you the right to buy the underlying at a particular price. So, of course, 1 tick in the money means you're going to wind up getting long, whatever that underlying is, in this case, an individual equity like an Apple or a Facebook or whatever the case may be. If you buy a put, of course, the put gives you the right to sell that underlying, so it's going to be exercised for you, and you will get short that underlying at the price, the strike price of that option. So that's a very basic process, and that luckily has been tweaked enough in the modern era so that it isn't as confusing as it used to be. And most of that is hands-off. You don't really need to do anything. That's something I want to really get out there to a lot of our listeners who say, oh, wait a minute, do I have to contact my broker to do this? No, that's hence the name automatic exercise. It's done for you. If it's a penny in the money, you don't have to do anything. Now, if for some reason you don't want to take that underlying, maybe you don't have the capital in your account, you kind of weren't banking on having to actually buy that stock, you could contact your broker and go through that process and try to not do the exercise. But that's something you have to do proactively. But if you want to just effectively say, you know what, I want this stock anyway, then by all means just let it happen, and it's not going to require you to do anything on your part, which is nice, which is refreshing in this day and age. You don't really have to pick up the phone and call your broker and say, hey, I actually want to exercise these options, and it's done for you. Now, Dan, the people get a little bit more screwy, a little bit more, shall we say, things get a little bit more dangerous perhaps, and a little bit more confusing when you get to the dark side, the short side of options. So why don't you walk our listeners through, if they're selling puts or selling calls just outright, what happens to them in the settlement/assignment process?
Yeah, Mark, this is where it can get a little bit more tricky. So one would assume that if you're short an option, it should be rather straightforward. And in fact, probably some of the false assumptions kind of come from your options 101 class that you took 10 years ago or whatever. You assume that, hey, I draw this P&L diagram and it tells me that if the option's out of the money, it expires worthless. And if the option is in the money, then what happens? Well, if the option is in the money, then it gets assigned and becomes stock. If I'm short a call, it becomes short stock. If I'm short a put, it becomes long stock. So truth be told, most of the time that actually is a reasonable assumption because, if an option is in the money and has value, if I don't exercise it, then I lose that value. I mean, even if it's a losing trade, it's less of a loser if I exercise it and capture that value, right? So, you kind of go with that assumption and figure, well, yeah, if it's in the money, it's going to get assigned and I'm going to take possession of stock, whether long or short. But here's the thing. Even though that intuitively it makes sense for the long to exercise, sometimes the long does not want to exercise. And even though, as a long option holder, if an option is in the money by a penny, the Options Clearing Corporation does you the courtesy of automatically exercising your options so that you get that value. You might look at it and maybe an announcement, maybe earnings or something comes out after the close. And the stock moves dramatically and you say, oh, wait a minute, I don't want to exercise this. I'm long calls that were in the money by a penny, but now the stock's down $3, after the close, or at least looks like it's going to open and, a bunch lower because earnings were terrible. So you know what? I'm not going to get automatically exercise and capture that penny. I'm going to call my broker and give them what's called contrary exercise advice. And that says, even though it's in the money, I don't want to exercise. All right, so that's the long. Sometimes if you're short an option and it's in the money, you think, oh, yeah, no problem. I'm going to get assigned. I've got a plan for this stock. Maybe it's like a covered call, for example, right? It's a covered call where I'm long the stock and the call's in the money by a couple pennies and you're like, oh, good. I wanted to sell the stock here anyway. Great. I'm going to wake up Monday morning. My call's going to get assigned. I'm going to sell my stock. I'm going to have no position. Everything's going to be great. But the guy who's long that call, or gal who's long that call, decides, no, I'm not going to exercise because maybe the stock's way down after the close. And you happen to be the person on the other side of that trade and you don't get assigned. The call that was in the money expires, and next thing you know, that long stock that you own, which is down $5 or whatever it is, ends up being a tremendous loser. So you can't really assume. You can't assume that just because something's in the money means you're going to get assigned. Now, again, most of the time, by and large, probably 98% of the time, you're going to get assigned if it's in the money. But there are those times you don't. Now, if you don't mind, Mark, I'll run with this just for a little longer.
Run away, sir.
Yeah. So you have some risk. You have the risk of not getting assigned. Because in that scenario that I just described, thinking, oh, yeah, well, I'm going to be selling, I've got this covered call. I'm going to be getting assigned and get rid of my stock. That's exactly what I want to do. Oh, no, I wake up Monday morning. I still have the stock and the stock's down $5. How do you avoid that risk of that, 1 or 2%, I don't know exactly what the number is, but very small percent chance of not getting assigned on any money? Well, here's what you do. You take matters into your own hands. Close positions before expiration so that you don't have that risk that comes along every once in a while. That's, that's what we teach all of our students. Close positions before expiration so you're not at the mercy of the whims of someone beside you who doesn't have your best interests in mind.
That's kind of a key to all of this is if you find any of this process confusing or intimidating or arcane or mystifying, I don't blame you. It is still kind of weird. It's been updated. It's modernized quite a bit, certainly compared to when Dan and I first got into this business. And it was a very much more opaque process than it is now. But still, there are some weird nuances, and we'll get to that in a little bit on the index side. So if you want to avoid this entirely, the power is in your hands, as they used to say on those old after-school specials, where you don't have to go through this process. You can close out your position the day of expiration, even as long as you do it before that bell closes. You even have a little bit of time afterwards to play around with a little bit if you can contact your broker and do a few things there. But either way, it's effectively you have until effectively that bell rings to close it out, and then you don't have to deal with any of this. And that's the advice most pros in this space will give you. This process is opaque. It's weird. Unless you really want that underlying, you really don't need to. You don't want to go through this process. If you have a short that's against you, I know that's painful. You have to take a little bit of a hit there. But then it's better than dealing with the alternative, getting loaded up at the underlying at an unfavorable price and have to unload that down the road. You don't want to deal with that process if you don't have to. And the capital that is involved in doing all that, there's no reason to go through that. So close out your shorts, close out your longs going into expiration. We used to do this all the time particularly when I was out in the SPX. And we'll get into that now because the other side of this coin is the indexes. And that's where things get a little bit screwy. And Dan, I don't know if you spent any time out in the S on the SIBO, but it was a weird place. And what we used to do, even as professionals, was we would go around and close out pretty much everything front month. There really weren't any weeklies then, so we didn't have weeklies to close out. But there was front month was the name of the game, and we would close out any strike even remotely close to at the money that had any sort of chance of really expiring in the money or becoming irrelevant. And sometimes we would do it, and the brokers would be like, "What are you doing here? Why are you closing this thing 20 handles away from the money?" But we would even do that just because it makes more sense to get that off your books, get that risk off your books than it is, and the hassle off your books than it is to have to deal with this whole process. So even professionals do that, listeners. I don't think you're taking some sort of coward's way out or anything along those lines if you're doing that. That's the smart way to trade, is to not to deal with this process. And when you hear about what's going on with the indexes, you may actually agree with that. So indexes. Now we're talking big, broad-based indexes like SPX options, which are the S&P 500 options, big traded on the floor, still one of the few still primary open outcry products still in existence out there, trades on the floor of the CBOE, a place I used to trade and Dan used to trade as well. And it's interesting, shall we say, the way the settlement process works in these is a little bit different. First off, let's get this out of the way. When you have the equity options, those expire into the underlying. They expire into the stock. So you get long or short the actual underlying you're trading. Obviously, with the S&P 500, there is no S&P 500 stock per se. So what you're getting, I mean, there are futures and other things, and we'll get into the difference of that in a minute, but effectively there is no underlying to expire to. So what this is, it's all driven off of just essentially a calculated index. So what happens is these options are called cash settled. They expire into cash. You get a nice little credit or debit into your account based on how much money you made or lost on that position as it goes into the settlement. So that's the first change. You're not getting any sort of underlying when these indexes settle. You're getting actually cash, which is a little bit different. Maybe you prefer that, maybe you don't, but that's a little bit different, and that's probably the first major difference here. The second one is, of course, these expire a little bit differently. They don't expire on that same Friday like everything else does. They actually expire the Thursday before that Friday. Why is that? You know, that gets into the weeds of the nuances, the birth of these contracts. That'll probably more time than we have time to really left on this program to discuss. But yeah, the nuances of SPX and other index products. This is not unique to SPX, of course. SPX is just the flagship one everyone talks about. That's a conversation for another day. But yes, it expires on that Thursday. So that's another thing. If you don't remember that, okay, wait a minute, I actually have one less day to trade this than I actually thought. And so if you're expecting to go in on that Friday and do all your closing, well, guess what? You're kind of out of luck. And also the way Dan, since you outlined this in your newsletter, I'll let you run with this one. I spent a lot of time doing these opening rotations out in SPX, and they were never a fun process. They were never certainly my favorite part of being out there. Again, I don't know if you spent any time in the SPX pit, but give us your thoughts on and explain to our listeners what we're talking about when you have this unique process of index settlement and these effectively opening rotations that have to decide where all this stuff is actually priced, because it's kind of mystifying, even to pros many years later.
Yeah, I kind of want to clarify right down to a gnat's behind here some of the things that you just said, because there are some real super intricacies here, and I've got a great story to tell about this too. So, the third expiration Thursday in SPX is the last trading day, to be sure, to really use really gnats behind nomenclature here. It's the last trading day, but they're AM settled. The closing prices, or the settlement price, is based off Friday morning's opening rotation, or opening price rather. So that being said, every once in a while, you can kind of run into some trouble. And this was many years ago. I bet this was about a good 7 years ago or so. My kids were a lot younger, and we went to a water park. We were staying overnight.
That's your first problem, sir. No, nothing good happens at a water park. It's all downhill from there.
Yes, yeah. Now, for those of you who don't have kids, or you have been fortunate enough to have never experienced a water park, it's a great cross section of America. First of all, I'll tell you that. But I don't know. The kids want to go, so what are you going to do? You go. They serve beer there, so, it's a little bit of a compromise. So anyway, it was Saturday morning, and I'm at the water park, and wouldn't you know, I run into a trader friend of mine. And he's a guy that I hadn't seen in a while because I spent most of my time in the equities. And in fact, I think I was off the floor by this point. But he was an SPX trader. And he told me, or index trader, anyway, regardless. He told me, I don't know if I'm going to have a job on Monday. I said, oh, geez, what's going on? And, what happened is there was a big overnight gap from Thursday to Friday morning. And I guess it was a gap lower, as I recall. It's a long time ago. But he was short a ton of puts that he wasn't worried about, didn't close them out because they were really far away from the money, but apparently not far enough. Because when the market opened up Friday morning, all those options that he thought were out of the money that were going to expire and not be a problem end up being in the money. And the way cash settled options work is that if you're short an option, the in the money value is what you have to pay. That's what you lose. That's what you pay to the clearing firm, and they hand that over to the person who was long that option. So I don't remember the dollar amount or whatever, but it was well into the six figures of what this guy lost just because he decided, well, I'm not going to close these out. They're far enough away from the money. It's no big deal. Every once in a while, it's a big deal. And I don't know. I don't think I talked to that guy after that because we didn't really keep in contact. But I don't know if he lost his job or not. But he lost a whole bundle of money because of two things: the settlement process, which is the thing that's out of his control. But what was in his control is that he could have closed them out.
Yeah, I'm guessing if he routinely did that and had a habit of not closing out of the money puts like that, short out of the money puts, that even if he skated on that one, he probably wasn't too long for the business down the road. Anyway, that'll come back to haunt you pretty quickly. And like I said, no good things happen at the water park. See, it ruined his life and his career.
Exactly. Yeah, what did we all learn from this experience?
So, but you make a good point. You do have a little bit of wiggle room, but not really in that opening moment where they effectively determine, listeners, what is known effectively as this settlement price. And is determined in, I think, in a methodology that is still, shall we say, controversial to this day, because in many ways it doesn't have to reflect where the index closed on Thursday. And a lot of other things could have happened overnight, and other things that could have happened, and they're going to effectively determine the value of all these component holdings of the S&P 500, and then from that will determine some sort of value for the index, and that's going to be your opening value. Then, of course, you have this still kind of weird process that goes out, and they call this opening rotation, where they will actually open these different products based on that settlement price. It's very weird, and quite frankly, your mileage is going to vary in this settlement process. I very rarely hear someone who held their options through settlement and came out extremely happy. Oh, yay, they really marked it in my favor. It could happen, but it's very rare. People are always upset with this settlement. And that's what's going to happen when you go through any sort of process where the outcome is not exactly throwing a dart at a board, but there is a little bit of that randomness factor, a little bit of a random variable thrown in there. And if you make your positions subject to that, then you're probably not going to be happy with the outcome 9 times out of 10. So again, this goes back to the old thing we were just saying before. If you don't want to deal with this kind of opaque and kind of head-scratching settlement process, then don't do it. Close out your position. Don't be like that guy at the water park or like Dan. And ride your short puts and then hope for the best, or they forget about them and forget about this. You still have to go through settlement the next day. Oops, I still got some short puts in my back pocket. I forgot about those. And oh no, my career is now over. Don't be that guy. Close it all out, even if it's remotely relevant. You don't have to worry about any of this. That's kind of the moral of all of this story we're talking about here, is that no matter what your views are on this kind of bizarre process that still exists in options, you can avoid it if you just close things out. So let's do a quick recap. Then we'll get to some of your questions. Again, you guys listening live can ask questions, including the folks over there in the Market Taker Elite community who are streaming live and chatting as well over there. So we welcome you guys. We got a lot of people who have sent in questions as well, but we want to make sure you guys live have some questions. So if you guys send them in, we'll bump you to the front of the queue. So really quickly, just kind of recap what we just talked about. If you have options, they do have this expiration you have to deal with. And what happens around that expiration is known as the settlement process, where your options will settle out In the case of individual equity options, they will settle out into longer short positions in the underlying itself. So it's fairly simple. If you're long a call, it expires into an in-the-money option will expire into the long position. You're long a put, and in-the-money put will expire into a short position in the stock. Vice versa, if you're short those options. If you short that put, you're going to end up owning some stock. And if you short that call, you're going to end up shorting some stock. So be aware of that. Now you get into a lot of these indexes that are cash settled, different beasts entirely. You're going to get cash debits and credits in your account instead of some sort of mystical index underlying. So be prepared for that. And then also at the end of the day, the equities don't have this, but the indexes have. They effectively close at a different day, which is Thursday for a lot of these contracts. Dan's right. There is a little bit of wiggle room on that Friday morning, but I wouldn't come in banking on that to save your bacon if that was your plan, and didn't work out for his friend at the water park. Probably won't work out for you as well. And they have to go through this kind of opaque process called settlement, where they determine the value that index is actually going to go out at. And that's the price that all of your options are calculated from. So let's say the S&P went out at 2,000 the night before, and then they determine the next morning there's an overnight rally in the futures, and they determine the settlement value is now 2,100. Well, guess what? All your options are going out at that instead of where it closed the night before at 2,000, and that 100 handle difference, that could be huge, obviously. So that's an extreme example, but still, if you don't want to be subject to the vagaries of this kind of process, then by all means, close out everything before you get there, and you don't have to worry about it. Dan, any last thoughts on the mysteries, the vagaries of exercise and settlement and expiration before we move on to some of these live questions?
There's always going to be some of these little nuances. I kind of pointed out what I think are some of the real important ones. I'm sure as we go on, we'll probably come up with some more.
All right, and speaking of coming up with more, that's what your guys' job is right now, because we're going to get right into the Options Bootcamp mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call. Like the name implies, this is the portion of the show where you guys get to take the reins. We don't do this show as often as I would like because we have a backlog of questions, but we also want to make sure we added an extra wrinkle this week in case all that backlog wasn't enough. We want to give you guys a chance to ask your questions live. Of course, all of you in the Mixlr can do it there. Just if you have a Mixlr account, you can do it directly in the chat, or a lot of you also like to use the Twitter and the Facebook and all the other fun stuff while you're streaming live in Mixlr. You can do that. And also, Dan, we added an extra wrinkle. For this show, people can also ask questions via your community. Why don't you tell them how to get there really quick?
Sure. You can ask questions by going to markettaker.com/community. So market, like stock market, taker, take something, 2 T's in a row, markettaker.com/community. We'll be happy to answer your questions there. And one of the advantages using that is you can use some visual aids if you like. Hey, look at this option chain, look at this chart. So check it out.
All right, Dan, I'll let you keep an eye on your community, and you let me know when they're waving their finger. We're going to try to make our way through this backlog. A lot of these come into this show. All these also come in some of our other shows, but I think they're kind of interesting and worth discussing for this audience as well. So we wrote a couple additional ones in here as well. So we have quite the backlog here. Let's see how many we can get through. Let's start with this one. This one here. This one comes from Mike. He says, "Hello." Well, hello, Mike. Love the show. I'm curious as to why one would ever use a collar instead of a bull put spread. Am I incorrect in thinking these strategies are identical with respect to risk and reward? Since the put spread will cost less to put on, it seems like the better trade. As an additional advantage, there is no need to tie up the capital to hold the underlying. Thanks for your help, Mike. All right, let's do a couple of clarifications there. First off, collar, if you're not familiar with that, that is indeed you own an underlying. It could be, let's say in this case, an individual equity like an Apple. And then maybe you're concerned about a little bit of downside, so you buy an out-of-the-money put to hedge that. And now you realize, this cost me some money. I'm going to also turn around and sell a call against that underlying to help finance some of the cost of that put. And as a result, you kind of clipped or collared the movement of that underlying in both directions, to the downside and to the upside, hence the name of that strategy. So that's what he's referring to with a collar. Now, with put spreads, And the notion, I think a lot of people get confused by bear and bull put spreads, but it's kind of your straight up put spread is, of course, buying out of the money put usually, and then selling a farther out of the money put against it. That would be your traditional bear put spread. The bull's going to turn that on its horn a little bit and turn around and actually sell an out of the money put. So it's going to be bullish, aka the name, and then buying a farther out of the money puts kind of to protect against the worst coming to pass. So this is an interesting mix, Dan, I think, of two different strategies. We talked about the collar before here on the show. We talked about put spreads as well. We haven't really compared and contrasted the two. I'm curious for our listener here, Mike, what do you think about his kind of comparing these two strategies? He says the put spread is his preferred one because it costs less. Well, obviously, you're not going to have the underlying component, so that's a nice savings in and of itself, regardless of the two strategies. But what are your thoughts about him comparing these strategies and his preferring the put spread over the collar?
Yeah. For those of you who aren't familiar with what we're talking about, Mike's talking about synthetic relationships, and he is indeed correct that the risk-reward profile, like the amount of money you can make and the amount of money you can lose and your break-even and all that, really is almost identical when it comes to a collar and a short put spread or a long call spread, bull put spread, bull call spread. So when we're talking about using the same strike prices, those three positions are actually risk-reward wise nearly identical, right? So where the difference really comes in is in utility. If I'm sitting here and I've got no position and I think, you know what, over the next 6 months, I think that this stock can get up to this point, and if it's above that point, I'm happy giving up upside. But if it gets down below this point, then, I want to cut my losses. Then, yeah, you're definitely way better off with either a debit call spread or a credit put spread. Really, functionally, those two are really almost completely identical, even in utility. The only difference is one, you get cash up front, the credit spread, but then with the credit spread, you still have to post margin, so you're actually still paying for it either way. So those are really almost nearly identical. But conversely, if I've got a stock in my IRA, now maybe I've been holding for a couple of years, and maybe I've got a concentrated wealth position in it. Maybe I used to work for that company. I happen to own 10,000 shares of it, and I'm not inclined to sell it, at least not right now. Then it makes perfect sense to do a collar, which is selling an out-of-the-money call and buying an out-of-the-money put. And then, yes, of course, you do end up with that same risk-reward. You will make or lose the same amount of money, but, that's a situation where you already have the stock. That's, kind of done in an investment, especially with a concentrated wealth position where, like I said, maybe you either inherited a whole bunch of Apple stock or, you used to work for XYZ company. That's when you use a collar rather than the vertical spread.
Yeah, collar to me and to most people out there implies the underlying component. You can't really separate the underlying component from the collar. It's not a collar anymore. Then it's just pretty much a risk reversal at that point. We had this debate on another show recently: collars versus risk reversals. So he clearly, if he's concerned about the capital to hold the underlying, then he's not going to be a fan of the collar in any regards. And I'm much more of a fan of typically not doing these spreads tied to underlying. A lot of our listeners are, though. They're coming from the stock world. And if that's the case, the collar is a great use case. A lot of professionals, financial advisors, and asset managers also flock to the collar because a lot of them are long the equities, long the underlying market, and so they need to hedge, and they want to reduce the cost of that hedging. So the collar I've often referred to as the holy grail for financial advisors because that's very much what it is. So if you can handle a position like that, you're more sophisticated than 90% of the financial advisors and asset managers out there, listeners. But that said, yeah, if you want to free up capital, the collar is not the use case to go. Speaking of freeing up capital, got the question here from Connor. I like that name. He asks, I suppose he's referring to me, do I ever do spreads in leaps? Why and how? If so, he goes on to write, so I used to trade the leaps rather than buy the stock. Is that a good use case? Yes, I'm a fan of that use case. Let's just clarify now. Leaps, of course, long-term equity anticipation securities. It's a bit of a mouthful. It stands for effectively options that are, let's just use the beyond a year time frame pretty much. That's kind of what you're talking about with LEAP. So you're talking about a year, 2 years, 3 years, in some cases longer down the road. So very, very long-term options. I typically don't like playing in those, and I don't recommend a lot of listeners for a program like this really play in LEAPs, particularly for what he's mentioning, spreads. Doing a vertical in a LEAP or something along those lines, it's not, you're not going to get the bang for your buck that you want unless you really sit around and wait for 2 or 3 years or whatever long the lifespan of that option is for that spread to really move the way you want it to. How many times have people written into a show like this doing a monthly option and then the spread and the underlying moves their way, and they write in saying, how come my spread didn't move that much? And it's because of all the nuance we talked about before, like time decay and everything else has to work its way out. And if that's an issue in like a monthly option, then forget about LEAPs 2-3 years out. It's going to be a whole different ballgame. But that said, I'm not a fan of particularly retail slinging into LEAPs, with the exception of what he mentions at the end. That's probably my sole really use case that I can really get behind for a lot of retail out there with the LEAPs, which is as what he's referring to. He says using the LEAPs rather than buying the stock. That's also referred to as a stock replacement strategy. We've mentioned that on this program before. Again, go look at the archives and you can check it. We have a whole episode, or a good chunk of an episode, devoted to this. But effectively what it is instead of buying the stock, and again, getting back to the capital concerns that Mike also had, buying the stock is expensive, and the best you can do with margin is 50%. So now you're talking about putting up half the cost of that stock and then sitting on that, and that margin, that stock, that capital can't do anything. Now you're looking at an option. Obviously, options are levered instruments. So in the case of using a stock replacement, you're typically going to go, let's say in this case, you go out, I don't know, a year. So you buy a 1-year LEAP, and you're typically going to go somewhere. And how you execute this is a little bit, it depends on your preferred use case. I like to go 70 plus delta, maybe a 70, 75 delta. So you're going to go in the money, but not extreme, not like a 100 delta option. That's going to be expensive. So you talk like a 75 delta, maybe an 80, somewhere along those range. Somewhere, so an option that's fairly in the money, but not ridiculously so. And now what you've done is you swapped out this relatively expensive stock position for an options position that is levered. It's going to cost you far less than the 50% if you do it right. If you go extremely in the money, that cannot be the case. You're spending extra dollars there. But if you do it right, it's going to save a lot of capital, going to free up that capital for trading. You're going to have a position that is somewhere in the 75 to 80% range of being what the underlying is anyway. So now you have this great, effectively long underlying position. You freed up a lot of capital to do it. And now you can turn around and do a lot of other fun things like write maybe front month calls, covered calls against it. So now you've effectively done a bit of a long time spread there. But what you've done is you've created, some people call it a synthetic covered call. Our friends over there at Trade King call it a fig leaf. I still don't know why they call it that, but they like to call it that. So a lot of different names for that strategy, but that's one of my favorite use cases for LEAPs. You swap the LEAPs in for the underlying, free up a lot of capital, and then turn around, maybe write some front month or even weekly calls against that. Now you've got a great thing that's going to pay off the cost of that call and then some over time. That's going to free up a lot of capital to do it. And also, you have the Greeks in your favor. And Dan, I know you can get behind this. You're the Greeks man. When you swap in an option for the stock, now you have all the Greeks working in your favor. Remember, you have a delta. So this underlying drops, which is the worst case scenario in that. That delta is going to decrease. So you're going to lose money at a slower rate. You don't make money, but you lose money at a slower rate. You have a vega, so a volatility underlying drops. Vega is going to increase again, going to slow your rate of loss. So there's a lot of nice things about having that option in there, in addition to the capital appreciation that I like, which is one of the reasons why I wanted to make sure we talked a little bit of LEAPs here on this program. Dan, anything to add here for our friend who wants to know, is this a good use case for using the LEAPs?
Well, I mean, I've gone on record saying that the only time I really like LEAPs is when it is part of a diagonal. Outside of that, I don't see any other practical utility for it, because even using it as a stock replacement strategy, to me, there's all these delta, gamma, theta, vega, rho. All those are almost kind of detriments when you use a LEAPs option, like factored into your theta. Well, most models factor into your theta the time value of money. And yeah, you get to keep all that money in the bank, but you're paying for it. What you're saving, or, imagine a scenario where you could earn interest on money you put in the bank, all that is already factored into the price of the option. So, that doesn't matter. Your delta is probably going to be pretty close to 50 unless you're very far in or out of the money. So, you got to do 2 options for every 100 shares you want to have exposure to anyway. You have all this premium paid over parity that is just going to slowly bleed out, and that's like the leverage advantage that you're getting. You're paying pretty dearly for that leverage advantage. So I think the model is designed to make it kind of work out as a wash, like all the advantages you get for buying a LEAPS instead of buying stock should end up being like a break even. Like that's why the option is priced that way. But I think it's actually ends up being a disadvantage for you to own the LEAPS because of all the premium over parity and all the stuff that I talked about. And, especially with spreads, I mean, you're just tying up capital for a year or two, and you're not going to really make or lose anything because your delta is going to be so small, because the delta of both of the LEAPS are probably going to be pretty close to 50. Those long-term options, the deltas tend towards 50 the more time till expiration. So, I mean, basically you're just putting capital into an account that's not going to make or lose you money for 2 years. Why tie it up? It just doesn't make any sense. Put it to better use. So, yeah, the only way I can see a good use is with a diagonal. Buy in the money LEAPS, sell a short-term out of the money call.
There you go. I think everyone can get behind that. By the way, we have Jeff Quinn in your chat room there, Dan. He commenting on what I was saying before about why they call it the fig leaf strategy. He says the folks at Trade King call it a fig leaf because you're, quote, partially covered, which is, I guess it makes sense. I have to go study the shape of my fig leaves. I guess my botany is not up to speed. But I'm talking to Brian and that team over there. Actually, I believe it was one of their clients who came up with the name. They put it out there for client vote, and a client came up with that, and he kind of liked it. I think for the reasons you described there, because you are kind of partially covered. I like to throw in his face synthetic covered call because I know he hates that term. And so I like to rub that in a little bit with him. But there you go. Your chatters, your community members there, Dan, coming in to the rescue with that. All right, let's go on to this one here from Tradecraft. I like this handle. Got some good handles today. Is there a correlation? I think he misspelled that. I'll just go on and assume he meant correlation. Is there a correlation between high options open interest and options price levels? All right, open interest, a very fundamental concept in the options world. What that effectively means is kind of your net aggregate open positions on any given strike. This is kind of a bit of a hotbed of controversy in the modern era. Everything in the markets is getting done on a sub-second basis, and the notion of out trades is gone. And yet we still have this relatively legacy open interest system, which only updates once a day. And a lot of people are kind of upset about that. They want this to update at the very least intraday, if not instantaneously, so we can see exactly when positions are opening and closing. Certainly there are other parties in the market who stand against that. They want a little bit of they like that little bit of lack of transparency on the day to kind of keep their positions to themselves. So kind of a bit of a push and pull on this one, but that's what they mean when they refer to opens interest. Again, if you have questions about that, check out some of the earlier episodes of this program or surf on the Options website, Options Insider website. We have it all there. Search for open interest or contact Mr. P over there, and they'll walk you through it over there in the market taker land. He wants to know, is there a correlation between high open interest and high options price levels? And not at all. Just pick your high-priced underlying name out of a hat. And we actually says options price. I thought you meant underlying price levels. Is there high open interest? Let's a couple of things you can probably assume when you see a high open. Not always, because you can look at one strike. There could be one big trade on that one strike, and then the other strikes could be kind of vacant and nothing going on. So people often assume high open interest translates into high volume. That is not always the case. If it does, if there is a high volume, then what you'll see is a very, very tight bid-ask spreads typically in those options, and so that will translate into that. You mean by options, high options price levels? That's a little bit different. That means you're talking about a lot of volatility typically in a name that's going to increase. What Dan was talking about before, that old premium over parity concept, that actual fudge factor there in the options, that volatility component to an options price. That's what typically translates, all other things being equal, into higher options price levels, is a higher level of volatility. High open interest is typically not going to do that. High open interest can sometimes be surmised to indicate higher volume. Therefore, you should have a little bit easier time getting back and forth. But again, that isn't always the case. So buyer beware on that. And in terms of underlying price levels, which is the way I initially read this, no, there are a lot of names out there that are extremely rich names, Berkshire Hathaway or Pricelines or others that don't have a lot of strikes with high open interest out there. So it doesn't mean because it's expensive, it could actually be the opposite. The options are now more expensive to trade as well. And look at the old days of Apple when Apple was 700. The industry was kind of lamenting that these options were too expensive. The underlying was too expensive. So they actually came out with many options to try to offset this impact of that. So usually it's kind of actually the opposite. If the underlying is really expensive, you tend to not have a lot of options trading because people, except for big institutions, can't really afford to, let's say, sell a 10 lot of puts because they can't afford to be put 1,000 shares of $1,000 underlying. It just doesn't work out for them. Mr. P, anything to add here on Mr. Tradecraft wants to know correlation or perhaps lack thereof between high options open interest and options price levels?
Yeah, I mean, going back to what I think was probably the original intent of his question, I mean, just think about it. Like, what do you do, Mr. Tradecraft, when you trade options? Do you just buy calls or do you sometimes sell options, like maybe sell puts or spreads or something like that? Because if somebody came in and sold, 1,000 puts, which, probably isn't a typical retail trader. I mean, maybe it's an institution if it's notwithstanding what Mark just said about doing that on $1,000 stock. But, I mean, there are maybe institutions that might come in and sell 500, 1,000 puts or something like that, maybe as part of a spread. If somebody comes in and sells a whole bunch of options, what does that do to the price? It makes the price go lower, doesn't it? It makes options cheaper, makes applied volatility go lower. And what else does that do? It makes open interest go up, right? Because they're creating more contracts. So if people are buying, there's buying pressure and there's open interest, then that means options are getting more expensive. But if there's selling pressure, selling open interest, then that's makes prices go lower. So there is definitely not a correlation that says, oh, if there's high open interest, that means prices go up. You're assuming that people are buying a lot of options, but it could be people selling a lot of options.
All right, Dan, I think we got time for one more here. We got so many. Let me see if I can pick a good one here to go out on. Here we go. This one comes from Ian Felder, and this actually touches on futures, which I know you're doing a lot more of over there in the MTM as well, Dan. So this kind of hits on all levels. And this is actually more of a comment. This is a comment from Ian. Like we said, he says, I started off in crude futures, and then I moved to VIX futures and now VIX options. So there you go, moving up the food chain there. Each time I trade a new market, I feel like I see more panoramic moves because I'm less familiar with the underlying in the first few days. It sounds scary, but it's actually refreshing. I guess looking at options has changed the way I look at futures. Has something similar happened to you? Have options changed your outlook on other products? I think that's a great way, a great comment, and it's a great way, I think, to look at options, because I think they do. I had the kind of a bit of a unique use case where I kind of came into the business from learning about options kind of first. That was really my first job out of college. So I kind of have a bit of a skewed perspective on it, but I did that purposefully. I did that because I learned about options early, and I decided these were a very, very interesting product and had a lot more nuances than, let's say, your typical Delta One products of your stocks or your futures. So if I could learn all the nuances of options, that would hold me in good stead if I ever wanted to try to learn about these other products, and certainly it has. If you can master all these concepts you're talking about here, like the Greeks and all the different nuances of spreads and synthetic relationships and all these things we're talking about in a program like that, you could then go back and apply those to a lot of other products and be able to wrap your heads around those fairly quickly. So from that perspective, I think, yeah, it definitely has changed my outlook on a lot of other products. And that's why we do a program like this. We think a lot of you guys out there who typically, let's say, use stock mostly, or in this case of Ian, futures, it's worth your time to learn about a new asset class, because this asset class you can use in conjunction with your old ones, or stock or futures, or to replace it and do things perhaps in a more efficient and more effective way by doing this. So certainly it has. Again, I'm down the options rabbit hole. So is Dan. So maybe we're the wrong people to ask about this, but still, it certainly has changed my outlook, and I like to think for the better. I don't know, Mr. Dan, you may disagree wholeheartedly, but what are your thoughts here on our comment from our friend, Mr. Felder?
Well, options are obviously a derivative of a stock, and actually a derivative of a future also, I guess you could look at it that way. And so the price of the underlying affects the price of the option. So obviously you have to look at the price of the underlying to understand how it affects the value of options. But, just agreeing with the caller, what do you call him? Caller? Question guy?
Listener, question asker.
Yeah, listener, right.
Fancy man about town, all the above.
Yeah. I think it probably forces you to broaden the way you think about the underlying. And I think it probably does make you a better trader of the underlying because, I think when you get used to trading these linear products, like all you're doing is looking at charts and you can kind of start to convince yourself, that you can predict the future and that you know which way something is going. Obviously the longer you are a trader, the less you believe that stuff. But, when it comes to options, like you really you're forced to go with the assumption that, okay, I can probably have a smarter than average opinion on which way the underlying might possibly go and maybe have some sort of statistical advantage in guessing the future. But really, like Socrates says, I only know what I know. And, like the whole nature of the option pricing model is based on that premise that stocks move in a log normal distribution and you can't predict which way a stock will go. So I think it forces you to be a little bit smarter about your analysis of the underlying, to be a little bit more realistic and to think more statistically rather than, clairvoyant. So, yeah, I'd say learning about options probably does make you a better futures or stock or ETF trader, yeah.
Look at Dan throwing out Socrates and log normal distribution and clairvoyance all in the same sentence.
Those are all the big words I know.
I think we better bring the show to a close before you use up your thesaurus on the rest of the program. But that's going to do it for this episode. It started off with an interesting voyage into the weird and wonderful and sometimes head-scratching world of settlement. Check all that out. If you have questions, hit us up on the website or via all the social media platforms, or hit up Dan and his team over there. They did a whole newsletter on it. They can, of course, also walk you through it, as well as all the other great options concepts out there. And before we go, Mr. Dan, I know you guys are always cooking up a lot of cool stuff. You obviously have the chat community over there chatting away, and also you have some new futures-oriented stuff. So if our listeners want to learn more about all that kind of stuff and check it out, where should they go? What should they do?
Yeah, we'll definitely surf on over to markettaker.com/community. That'll get you free access to a community of traders. You have me, John, and Craig on there all the time, giving market information, giving trade ideas. That's worth the free price of admission right there. But it also enables you to interact with other traders. So definitely go to markettaker.com/community. Even if you're listening to this on recording, it's available to you, so go there and you can learn about our classes, like our new futures class and everything right then and there.
Yeah, head on over the page. It's got a little sign up. Fill in your name and your email, and bam, you're good to go. And then you, too, can ask questions and correct me on fig leaves and all sorts of other fun stuff over there in the land of Market Taker. And on behalf of my options nemesis, Mr. Passarelli, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show, and of course for joining us live via Mixlr and via MTM and all the other outlets that stream us live. And we'll see you next time for more Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.